In 2026, the bill comes due, and it doesn't knock on Wall Street's door first. It knocks on yours. Your job, your rent, your savings, the price of everything you touch. And later in this video, you'll see the quiet mechanism that turns a boring refinancing problem into a real economy shock. Because for years, debt was treated like a magic trick. Borrow cheap, roll it over later, smile for the cameras. The numbers looked fine on a spreadsheet, the headlines sounded calm, and the central bankers sounded confident. But debt has a clock. And when enough of that clock strikes at the same time, it becomes a wall. A debt wall. Not a metaphorical one. A literal schedule of maturities stacked month after month, quarter after quarter, waiting for refinancing at a price that may not exist. Here's the uncomfortable truth. Most debt crises don't start with a dramatic collapse. They start with a meeting, conference room. A lender slides a term sheet across a table and says, "We can renew, but it'll cost you." The borrower smiles, tries to negotiate, and realizes the world has changed. The interest rate is higher, the covenants are tighter, the lender wants more collateral, and the market is less forgiving. And suddenly, the business isn't planning for growth. It's planning for survival. But here's what nobody tells you. The real economy doesn't break when debt is issued. It breaks when debt is renewed. Think back to the era when money felt almost free. Companies issued bonds like they were printing coupons. Real estate investors took out loans assuming rents would rise forever. Governments expanded deficits because the interest bill seemed manageable. Households financed cars, renovations, and lifestyles on the assumption that tomorrow would look like yesterday. Then rates rose. Inflation changed the rules. And the "we'll just refinance later" plan began to look like a cliff. This is the dangerous part. Refinancing isn't a formality. It's a test. It asks one simple question. Can you still convince the world you're safe? And in 2026, millions of borrowers all ask that question at once. Imagine a mid-sized company, let's call it Northbridge Components. It's not famous. It doesn't trend online. It makes parts that end up inside things you use every day. It borrowed aggressively back when the cost of money was low. Not because it was reckless, but because everyone did. It used debt to modernize equipment, buy a competitor, and expand its warehouse. The loans were structured to mature in a neat little stack that starts getting serious in 2026. Now picture the CFO staring at a calendar. There's a date circled in red. The company owes a big refinancing payment. The original interest rate was a gentle breeze. The new interest rate is a headwind that can tip trucks over. And the bank's message is polite, almost friendly. "We can do it, but we'll need a higher rate, and we'll need you to cut costs." Northbridge does what companies always do first. It freezes hiring. That sounds small. It isn't. Hiring freezes ripple outward like cracks in glass. The recruiter loses commission. The training vendor loses contracts. The local restaurants lose lunch customers. But that's only the beginning. Because the CFO then looks at the second line item. Labor is the biggest cost. And the pressure isn't coming from greed. It's coming from math. Debt service is now eating the oxygen that used to feed wages and investment. The company delays raises, then delays bonuses, then delays orders to suppliers. Then it quietly starts layoffs. What does this mean for you? It means the debt wall doesn't announce itself as a debt wall. It shows up as "we're tightening budgets." It shows up as "we're restructuring." It shows up as "we're being prudent." And if enough companies do it at the same time, the entire economy starts breathing shallow. But here's where it gets strange. The debt wall isn't one wall. It's multiple walls stacked together. Corporate loans, commercial real estate mortgages, consumer credit, and government borrowing. Each with its own schedule. Each hitting different parts of the economy, but all pulling on the same rope. Start with corporate debt. When rates were low, companies locked in fixed rates when they could, but plenty of them used floating rate loans, short maturities, or financing structures that assumed refinancing would be easy. Private credit expanded, leveraged loans grew, and "just roll it" became a strategy rather than a contingency. As long as the refinancing door stayed open, the model worked. Now imagine that door narrowing. Not closing entirely, just narrowing. Lenders become selective. They stop asking, "Can we lend?" and start asking, "Who deserves the last dollars we're willing to lend?" That shift is subtle, but it changes everything. Then there's commercial real estate, where the debt wall has a particularly sharp edge. Office buildings are the obvious headline, but it's bigger than offices. It's mixed-use properties, warehouses, shopping centers, and apartment complexes financed at valuations that assumed cheap money would last. Many loans were structured to mature after a few years, with the assumption that the property would refinance at a similar rate, or at least at a rate that still worked with rent income. But when interest rates rise, the math flips. A building that looked profitable at 3% financing can look fragile at 7% financing. The property's value falls because buyers price in the new cost of debt. And if the value falls enough, the owner can't refinance without injecting new equity. Many can't. Some won't. And then the lender has a problem. This is the turning point. Banks don't need every loan to fail. They just need enough loans to wobble at once to make them defensive. When banks get defensive, they do what they're built to do. They protect themselves. They tighten standards. They reduce exposure. They demand more collateral. And that creates a feedback loop. It's harder for businesses to refinance, so businesses cut spending. That slows the economy, which makes more loans look risky, which makes banks tighten further. It's a loop that doesn't feel dramatic until you're inside it. Now zoom in on households, because this is where the debt wall becomes personal. Not everyone has a mortgage that resets, and not every family carries the same kind of debt. But many households live in a world where monthly payments are the gatekeepers of life. A car loan, a credit card balance, a student payment, a personal loan, a rent increase, an insurance premium. When borrowing costs rise and lenders tighten, the most common effect isn't bankruptcy. It's stress. It's the slow squeezing of choices. And stress is economically contagious. When people feel squeezed, they postpone purchases. They trade down. They stop planning vacations. They cancel renovations. They delay replacing the car. That doesn't show up as a crash at first. It shows up as softness. A little weakness here, a slowdown there. But if it spreads, it becomes a force. But here's what nobody tells you. The debt wall is not only about borrowers. It's also about lenders needing to be paid back. There's a hidden dependency in modern finance. Many lenders, banks, funds, insurers expect cash flows from debt to behave like a reliable river. If the river dries or becomes turbulent, they adjust. And their adjustment can reshape the economy. A fund that was eager to lend becomes a fund that demands higher yields. An insurer that once bought long bonds becomes cautious. A bank that once competed for your business becomes choosy and strict. So why does 2026 matter? Because timing matters. It's not one loan. It's not one sector. It's the clustering. Debt maturities don't arrive evenly over time. They bunch up. And when the bunch is big enough, refinancing becomes a crowd trying to fit through a single door. Let's return to Northbridge components. The CFO makes a plan. Cut discretionary spending. Delay a new product line. Cancel a marketing contract. Shift from expansion to defense. But then something else happens. Their largest customer, a major retailer, also tightens budgets. Orders slow. Inventory builds. Cash flow weakens. Now the CFO's refinancing meeting is worse. The lender doesn't just raise the rate. They reduce the size of the loan. We can't renew the full amount. We'll roll part of it, but you'll need to pay down the rest. That means Northbridge must find cash. Fast. Where does a company find cash fast? It sells assets, it cuts labor, it squeezes suppliers, and it reduces investment. These are real decisions with real consequences. The warehouse expansion is paused. The equipment upgrade is delayed. The supplier gets paid later. The supplier then struggles to pay its own bills. What happens to your savings, your job, your life if this continues? It depends on whether you're standing near the first domino or the 100th. But make no mistake, the domino line is longer than most people think. This is the part that feels unfair. When money was cheap, borrowing was rewarded. Growth was celebrated. Risk was disguised as optimism. When money becomes expensive, the penalty arrives not just for bad decisions, but for ordinary decisions made under old rules. Companies that weren't reckless can still get trapped. Families that weren't irresponsible can still get squeezed. Now, let's talk about the government layer because it's the quiet amplifier. Governments borrow continuously, and when rates are higher, the interest bill grows. Even if the government never runs out of money, rising interest costs force trade-offs. More of the budget goes to servicing debt. That can mean less flexibility for programs, less cushion in downturns, and more political pressure. And when governments feel pressure, they can add uncertainty. Debates over taxes, spending cuts, emergency measures, and policy shifts. Uncertainty makes businesses pause. Businesses pausing means fewer jobs created. Fewer jobs created means households get cautious. And cautious households slow the economy further. But here's where it gets strange again. Everyone's trying to do the rational thing at the same time. Businesses try to cut costs. Households try to save. Banks try to reduce risk. Governments try to stabilize. Individually, each action makes sense. Collectively, they can create a downturn. It's a tragedy of coordination. 1,000 sensible decisions that add up to one big problem. You can see it in how the language changes. When times are good, CEOs talk about tailwinds, opportunities, growth initiatives. When the debt wall hits, the language becomes defensive. Discipline, efficiency, right-sizing, focus on core. None of those phrases mention debt. But debt is the metronome in the background setting the tempo. Now let's add the factor that turns a refinancing crunch into a broader shock. Defaults aren't required. You don't need mass bankruptcies for the real economy to feel it. You just need widespread tightening. If a company spends 5% more on interest, that money comes from somewhere. It can come from wages, investment, hiring, or prices. If it comes from prices, inflation can stick around longer. If it comes from wages and hiring, growth slows. If it comes from investment, productivity suffers. None of these outcomes are painless. This is the dangerous part. The debt wall forces a redistribution. Not between rich and poor in a neat moral story, but between past decisions and future possibilities. Money that could have been used to build becomes money used to maintain. Money that could have created jobs becomes money that services loans. The future gets mortgaged again, this time to pay for the past. Now picture the commercial real estate owner. Let's call her Maya. She owns a mid-sized apartment complex and a small retail strip. She's a careful operator. She didn't speculate wildly. But her loans mature in 2026. She goes to refinance and she's offered a rate that makes the deal barely workable. Maya has 3 options. Raise rents, cut expenses, or sell. Raising rents is politically and socially explosive, and the market may not bear it. Cutting expenses means less maintenance, fewer upgrades, less quality of life for tenants. Selling is hard because buyers are pricing at the new cost of capital, which means a lower valuation. A lower valuation might mean she can't repay the existing loan in full. So she tries to raise rents a little, cut costs a little, and refinance the rest. But the lender insists on a higher down payment. She doesn't have it. She calls investors. They want higher returns. She calls partners. They hesitate. The deal stalls. And then the lender says the sentence borrowers hate most. We need you to bring cash to close. That's when a financial issue becomes a human issue. Maya delays repairs. Tenants complain. Local businesses in the retail strip suffer from lower foot traffic because the area feels neglected. The strip's vacancy rises. That reduces income. That makes refinancing even harder. But here's what nobody tells you. Real estate distress doesn't stay in real estate. It leaks into banks, city budgets, construction jobs, and consumer confidence. Construction is a perfect example. When refinancing tightens and new projects become harder to fund, construction slows. That means fewer jobs, fewer orders for materials, fewer contracts for electricians, plumbers, and small subcontractors. Those are real people with real bills. And those bills don't care whether the problem started with a bond yield. Now let's take a detour into the mechanics, because the mechanism is the story. When debt matures, you have to pay it back or refinance it. Refinancing is essentially replacing old debt with new debt. The key variables are the interest rate, the term, and the conditions. If interest rates are higher than before, your payment goes up. If the term is shorter, your payment goes up. If conditions require more collateral or a lower loan amount, you need cash. In a stable environment, refinancing is smooth. In a tightening environment, refinancing becomes triage. And 2026 is when triage becomes visible. Not because everyone fails at once, but because the number of people asking for refinancing becomes too large to hide. This is the turning point. Lenders stop being intermediaries and start being gatekeepers. Gatekeepers change behavior. Suddenly, a profitable company is treated like a risk because its debt schedule is ugly. Suddenly, a good property is treated like a problem because its valuation has shifted. Suddenly, a household that used to qualify for a loan is told, "Not anymore." And when people are told, "Not anymore," the economy rewires itself around scarcity. Here's the part that will make you sit up. The debt wall can hit even if the economy looks okay on the surface. Because refinancing is about the cost of money, not just the pace of growth. You can have decent employment numbers and still have refinancing stress. You can have stable revenue and still see margins crushed by interest. You can have a soft landing narrative and still watch a wave of quiet restructurings. So what does it look like when the debt wall finally hits the real economy? It looks like layoffs that start in the most leveraged industries and spread to the ordinary ones. It looks like wage growth slowing. It looks like hiring freezes becoming the default posture. It looks like restaurants and retailers feeling mysterious weakness. It looks like cities collecting less tax because property values stop rising. It looks like small businesses struggling to renew lines of credit. It looks like consumers choosing the cheaper brand, skipping the optional purchase, and postponing the big dream. But here's what nobody tells you. The debt wall doesn't arrive as one event. It arrives as a season. In that season, you'll see the phrase maturity wall pop up more often. You'll hear about refinancing headwinds. You'll see more stories about companies swapping one lender for another, selling assets, spinning off units, and optimizing their balance sheets. That's the clean language for the messy reality. They're trying to avoid the moment when the bank says no. Now we're approaching the climax, so let's pull the threads together. Corporate borrowers are refinancing at higher rates. Commercial real estate is facing valuation resets. Banks are cautious because their own balance sheets are sensitive to losses. Households are stressed because the cost of living is higher and credit is tighter. Governments face higher interest costs and political pressure. All of that reduces the economy's ability to absorb shocks. And then something small happens. There's always something small. A regional bank reports bigger than expected loan losses. A large company announces a restructuring. A real estate fund gates withdrawals. A major employer pauses expansion. A big retailer issues cautious guidance. None of these is the crash. But together they change mood. They change risk appetite. They change what lenders are willing to do. This is the dangerous part. Mood is a multiplier. When confidence is high, lenders stretch. When confidence drops, lenders retreat. And in a refinancing-heavy year, retreat is gasoline. Now imagine Northbridge again. They're in talks with lenders. They're trying to refinance. But their revenue is down because customers tightened. Their costs are up because interest is higher. Their margins are thinner. They look riskier. The lender demands layoffs as a condition. Northbridge lays off 8% of its workforce. Those workers cut spending. Local businesses feel it. The local bank sees higher delinquency. The local real estate market softens. The local city budget tightens. The local school district delays a project. It's a chain reaction that starts with a single red circle on a CFO's calendar. What does this mean for you? It means you can be far away from the original debt and still feel the shock. Because the shock travels through jobs, wages, credit availability, and confidence. Now picture Maya, the property owner. She can't refinance cleanly. She sells the retail strip at a discount. The buyer is a distressed asset specialist. They cut costs aggressively. They raise rents where they can. They tolerate vacancies. The area feels colder, more transactional. Tenants feel it. Shoppers feel it. The community feels it. And this is where the story becomes emotional, because it stops being about rates and starts being about dignity, about stability, about whether people feel like the future is predictable. Now the climax, the perfect storm moment. In 2026, the debt wall collides with the real economy when refinancing becomes a synchronized squeeze. Not one sector, multiple. Not one borrower, million. Not one bank. A whole system leaning toward caution at the same time. Payments rise, terms tighten, credit shrinks. Companies don't expand, they defend. Households don't splurge, they conserve. Banks don't chase growth, they protect capital. Governments don't have flexibility, they argue. And the economy doesn't collapse in a single day. It simply loses momentum, then it loses more. Then it starts shedding what it can't carry. You'll hear people say, "Why does it feel like everything is slowing?" This is why. The debt wall is a gravity shift. The same amount of effort produces less lift. The same business plan produces less growth. The same paycheck buys less comfort. Now the punchline that nobody wants to admit. The debt wall doesn't care about your narrative. It doesn't care whether you think the economy should be fine. It only cares whether cash flows can support higher interest costs and tighter conditions. So what can happen next? One path is slow pain, lots of restructurings, lots of quiet defaults, a mild recession that feels bigger than it looks because it lasts. Another path is sharper, a credit event that forces lenders to slam the brakes, turning a squeeze into a snap. But there's also a third path: adaptation. Businesses deleverage. Households rebuild savings. Banks recognize losses and move on. Policy stabilizes. The economy resets to a world where money isn't free and borrowing has consequences. And that brings us to the real lesson. Debt is time travel. When you borrow, you pull future money into the present. You get to live, build, or spend now, and you promise to pay later. That promise is manageable when the world stays friendly. But when the world changes, when rates rise, when growth slows, when valuations reset, that promise becomes heavy. In 2026, that heaviness becomes visible. So here's the takeaway you can actually use. Watch refinancing, not headlines. Watch whether companies are rolling debt smoothly or paying higher rates. Watch whether commercial properties are refinancing without drama or needing cash injections. Watch whether banks are expanding credit or tightening it. Watch whether households are rebuilding savings or leaning harder on credit. That's where the real story is. Because when the debt wall hits the real economy, it doesn't show up as a single explosion. It shows up as 1,000 doors quietly closing. And if this opened your eyes, stay with us, because this story isn't over yet. Tell me in the comments where you think the pressure breaks first. Corporate layoffs, commercial real estate, consumer spending, or government budgets. And if you want more deep, clear stories about the invisible forces shaping your money, your security, and your future, hit like, subscribe, and join us for the next one, before the next door closes.